Hello, folks. It is Saturday, December 16. It's about 6:30 in the evening on the East Coast of the United States. In this video, we're going to talk about gold, which of course is my favorite topic. We're going to focus on an article written by Jim Rickards. It was published on Thursday. Let me share my screen here and we'll get going. So this is Jim Rickards talking about a price target of $15,000 gold. And he explains in the article how he arrived at that price target. One of the interesting things in this article, he's pointing out that prior to 1971, gold was money. That this period prior to 1971, which of course, that's when Nixon closed the gold window. It was in 1974 when the petrodollar, that agreement with Saudi Arabia was established. And so prior to 1974, 1971, gold really was money. We were still on the Bretton II agreement where all of the fiat currencies in the world were fixed to the US dollar, and the US dollar was fixed to a legally binding dollar amount per ounce of gold. It was $35 an ounce until you go back to 1933 when it was changed from $20 an ounce to $35 an ounce. And so anyway, the point that Rickards is making in this article is that he starts his analysis of bull and bear markets in the precious metals in 1971, because prior to that point, gold was money. Gold was money legally. That was legally, gold was money. Actually, it was silver. A US dollar was defined as a certain number of grains of silver. But anyway, precious metals were money prior to 1971. And so during that time period, before 1971, we could talk about inflation or deflation affecting the price of gold, but we didn't have bull and bear markets. And that's the key point that Rickards is making. And it's an interesting point that it's only after 1971 where we can really talk about bull and bear markets in gold. And so that's what he's doing. And basically he's looking at, we've had two bull markets in gold. The first was from 71 to 1980. The second was from 1999 to 2011. In the first bull market, we went from $35 an ounce to $800 an ounce. Depending on the chart you look at, some charts show that the peak was 850, and you see people talking about 850. On some charts, it's 875. But anyway, in this video, we're going to use the numbers that Rickards uses. And so we'll talk about a $800 peak. That was a 2,200% gain, 9.4 years. In the second bull market, we went from 250 to 1,900, 670% gain, 12 years. And then to talk about the third bull market, which that's what we're in currently. It started in December of 2015 after the end of a 4-year bear market. Gold was at 1050 at that point. Obviously, we're almost twice, almost double that 2015 bottom at this point. Price is currently at 2019 as of Friday's close. And so anyway, what Rickards does in this article is he takes a simple average of the gains and durations of those first two bull markets, and then applies that average to the third bull market to come up with his projected target of $15,070 per ounce by August of 2026. Yeah. And so that's what we're going to look at in this chart. Let's jump ahead. So this is an article, it goes all the way back to mid 2012. And then this is Richard Russell. And so Richard Russell, he watched the financial markets on a daily basis for more than 50 years of his adult life. And of course, he published a very famous newsletter, Dow Theory Letters, throughout that time period. So more than 50 years that he published his newsletter. And one of the things that he talked about consistently in his newsletter is that all bull markets occur in three phases. And it doesn't matter whether we're talking about oil, equity markets, precious metals. It doesn't matter which financial market we're talking about. According to Richard, any bull market occurs in three phases. And he was adamant on the point that the third phase of the bull market in gold had yet to occur. And he was making that point this is mid 2012, and he's still making that point and saying, so 2012, and of course, remember that gold had peaked in 2011. And so he's making this comment during the bear market in precious metals. It didn't bottom until 2015. And so he's pointing out that the third phase in the gold bull market still lied ahead, still was ahead of us, yet to come. And so still have not seen the third speculative phase of the gold bull market. That phase lies ahead. Another thing that Richard consistently said in his newsletters, and this has always stuck with me, in a bull market during the third phase, prices rise to a level that surprises even the staunchest bull. That even the most adamant bulls, gold bulls, silver bull, whatever you're a bull in the third phase of the bull market, prices rise even higher than you think that they will. And like I said, Richard consistently made that point. So anyway, let's take a quick look at the charts now. This was the first bull market that Rickards refers to, 71 to 80, $35 back in August of 71. We're using Rickards' number of $800 in January of 80. In this particular chart, the high was actually $875 an ounce. This is basically spot gold, $875 an ounce. As Rickards points out, 2,200% gain, 9.4 years. This is the second bull market in gold, 1999 to 2011. Start at 250, reached a high of 1900. If we look in this chart, it was actually, that's 1920, 1912. So, anyway, we'll use Rickards' number, 1900. That was a 670% gain in 12 years. And now we're in projection territory. So Rickards is taking a simple average of the gains and lengths of those first two bull markets and applying that to the bottom from 2015. And so he's expecting a 1,400% gain in 10.7 years. Well, notice, folks, that it's late 23. We're almost in 24. Gold bottomed in 2015. So 10.7 years, that's 2026. We're only 2 years away from reaching this expected target based on his analysis. And anyway, I find that interesting. It's easy to feel like, gold we'll never reach higher prices, but potentially just in the next 2 years, we will see dramatic increases in the price of gold. And of course, I won't be surprised to see that based on everything that's going on in the world at this point. But so anyway, that's what we're looking at in this chart. Gold bull market from 2015 to 2026. So this was the bottom, December of 15. Gold bottomed at 1050. This is where we're at currently. We've had 2 periods where gold created continuation patterns. Basically, it's the flagpole pattern where gold forms a flag. Let me draw one. So there's our flagpole, and then we get a continuation pattern, which is the flag, and then the pole duplicates itself. And so if we copy and created a copy of that, that would give us basically a price target there. And of course, we can see gold did far more than what that gold pattern would have suggested. So, but anyway, when gold broke out here in 2019, we reached a high of, what is that, 2075, so broke through 2000, and then went into another continuation pattern, the flag pattern. If we duplicate that flagpole, it gives us a target at 2555. And so that's my current target for gold is 2555. And I suspect we'll see that sometime in this coming year, 2024. Again, given everything that's going on in the world right now, both geopolitics and financial, I believe that that's a realistic target for 2024. But in Jim Rickard's analysis, he's suggesting this target at $15,070 an ounce in August of 2026, which basically gives us an exponential rise into that price target. Exponential markets don't end well. They tend to correct sharply, which would suggest that if we do reach this price target, that we'd get a big correction. Now, I've seen a number of analysts suggest that this time will be different. And of course, you know, famous last words in financial markets, thinking that this time will be different. But what we could see is part of the impetus, part of what will drive gold to these new all-time highs is that whether it's BRICS or Russia or China, there will be some country or some organization that will adopt gold as their new money or the backing for their new currency. And so some analysts suggest that we won't see gold pull back dramatically from its new all-time high, that, basically it may plateau, but it won't decline significantly. So anyway, just something to think about. Another interesting thing that Rickards points out is that when we look at this target, we're saying, $15,000, that seems unrealistic. But then he talks about percentage gains. And so going from our current, basically $2,000 an ounce up to $3,000 an ounce, well, that's a 50% gain. That's a big gain. And then from 3,000 to 4,000, well, that's only a 33% gain. And then the next $1,000, well, that's only a 25% gain. And then by the time we get to 9,000, the difference between 9,000 and 10,000, well, that's only an 11% gain. And so it's an interesting point that Records is making, that as we climb this price curve, um, each incremental gain becomes less significant. It's a smaller percentage gain as we climb this price curve. So, and I just drew some lines, based on this curve, this exponential curve, which, there's no science, no formula behind this curve. I just drew it on the chart. We get, December of 24, we get the price at 3,000. This is June of 25, we're up at 4,000. What is this? September of 25 at 5,000, December of 25, so on and so forth. So anyway, um, just some interesting ideas to think about in this article. And again, this was published on the 14th. I'll include a link to this article in the description below this video. That's all I've got. Look forward to talking to you tomorrow, folks. Have a good evening.